ये सिर्फ बर्बादी और कुछ नहीं। ये पहले ऐसा अगर देंगे तो हो सकता है, नहीं तो कुछ नहीं हो सकता सर।
Hello and welcome to Bloomberg Quint Live, and you're watching Trend Spotting. I'm Shraddha Babla. Good morning.
Good morning, Shraddha. I'm Agarwal, and in the next 30 minutes, we deep dive into specific trends in the markets to draw key takeaways and their implications for investors. First, the headlines. It's a steady start to the trading week. The Nifty trades about 10,350. Most sectoral indices gain, while IT and media lag. And ICICI Bank is the top Nifty loser after some directors on the board opposed to Chanda Kocher's continuing in the CEO's role. That's a Bloomberg exclusive. And oil marketing companies are among the top gainers on the Nifty as crude prices continue to cool off. And Indian bond yields move back towards 7.17 after RBI raises the FPI cap in government and corporate bonds. Lemon Tea Hotels lists at a premium of 10% to its issue price of 56 rupees per share.
The markets actually have come off a bit in the last few minutes or so, at least of the day's highs. Nevertheless, about 0.3% gains for all benchmark indices, Nifty, Sensex, Bank Index as well. The mid-cap and the small-cap indices also tracking gains in the benchmark indices. So up about 0.3%, so marginal gains for the mid caps and the small cap index as well. All sectors, in fact most of the sectors barring IT, are showing strength. PSU banks and media are also showing signs of weakness. So in fact Nifty PSU bank index has just turned negative now, so has the Nifty media index. Broader market breadth, however, continues to remain favorable, with about 5 stocks advancing for every 2 declining. Agam, any individual stocks you want to highlight?
Actually, I just want to mention, the IT stocks which are looking at, mixed cues, should I say, because you have some, stocks which are moving up and about in trade. And I think I want to address NIT Technologies specifically in this case, because we're looking at a decline out here as 1.4%. And, what's really standing out for NIT Technologies, of course, is that it's bucking the trend. We're looking at a little bit of profit taking after a substantial up move in the last week we saw. The other stock that I do want to mention is Balakrishna Industries, because we're looking at that extension in the kind of gains that we saw from last week. It's up another 3.7% today, and this is while we're seeing heavy volumes in the cash market, as well as a substantial increase in open interest in the derivatives market. And just one more stock that I do want to address is, of course, Mahanagar Gas. That stock is down in trade today. It's showing some weakness, and what we're looking at again is heavy volumes, as well as backed with fresh shorts building in with an open interest increase of nearly 20%. So these are 3 stocks that have caught my eye today, Shraddha.
Okay, let's also tell you what's trending today. One, we're seeing smart recovery as far as oil marketing companies are concerned. All are on the rise for the third consecutive session. So HPCL has risen about 4% or so. BPCL, IOC are also seeing gains to the tune of 2.5 to 3%. Remember, all of these were beaten down badly in March, so there's probably some interest coming back as far as OMCs are concerned. And then I also want to point out IT stocks, like Agam was saying, most sectors barring IT today are showing strength. And Agam, just want to understand from you what could be weighing on the IT index, more so on the Infosys, which is the heavyweight. Probably the markets have started to factor in Q4 numbers.
Yeah, absolutely, Shraddha. Infosys specifically, it is likely to be the earnings, as traders will start building their positions ahead of its numbers. Of course, Infosys announces its earnings this coming Friday, and I reckon that to a certain extent we will be seeing at least some position building up before the event comes in. Of course, this is as far as the speculators are concerned. Of course, as far as the other IT companies are go, as I said, we're looking at mixed trends coming in, depending from company to company. And we'll just have to wait and watch as to how they start moving, as and when we start getting, their earnings coming in.
All right. We'll keep a watch on all those IT names, Agam, and let's tell our viewers what we have lined up for you on Trendspotting today. First, we will discuss the impact of falling bond yields on housing finance companies with Digant Haria of Antique Broking. And then we will connect with Anand Agarwal of V-Mart Retail to discuss the company's store accretion plans. And finally, what's in store this earnings season? We will cover all of this in the next 30 minutes. It's the fourth successive year of slowdown as far as mainstream housing sales are concerned, and while the markets await the much anticipated pickup in affordable housing, the competition continues to rise. Now, in the current scenario, will the fall in bond yields change the market sentiments towards housing finance companies? Well, let's get an analyst view from Digant Haria, the Assistant VP Institutional Equities at Antique Broking. Good morning, Digant, and thank you for joining us. Now, bond yields rose by about 67 basis points in the third quarter. Then they fell nearly 6 basis points by the end of Q4 after government lowered the H1 borrowing program. And then now they've dropped further by another 10 to 15 basis points just in the month of April so far. Does this really change the sentiment or move the needle for housing finance companies?
In our opinion, not so much, because see, if you look at the last 2 or 3 years, all these housing finance companies, they benefited a lot from the bond yields declining, and a lot of these housing finance companies went very aggressive in the non-housing segments, especially the loan against property or funding the developers or entering the LRD markets. Now, what's happened is that because the growth in the mainstream housing is not picking up, this entire space, which is LAP or builder loans or LRD market, that has become a very, very crowded space. So, we have seen that deals happening at sub 10% levels in this segment. So, even the larger guys like HDFC or L&T Finance have become too aggressive in this segment. So, when AAA rated guys become very aggressive in this segment where you are earning good yields, I think the yields are bound to come down. So, bond yield going down is just one part of the story. The other part of story is that the large expansion which happened in LAP real estate segment in last 2-3 years, I think we are seeing some signs of stress there because the sales are not picking up, and if the builder is not able to sell the house, how do you expect him to service the loan? Like, already 1 or 2 levels of rollovers or restructurings have happened, and if sales don't come, I think it will be slightly difficult for a lot of these companies who are very, very heavy in these developer segment. So I think bond yields going down does not change life so much. Yes, it is a bit of relief compared to say last month, but yeah, I don't think it changes the structural nature of this market.
Digant, what about valuations going down? Some of these stocks have seen sharp corrections, at least from the kind of share prices that we had seen back in December, Jan, after which they started falling. So at these levels, do you believe most of the housing finance companies, at least the ones that you cover, are fairly priced?
See, I think the sector reached its peak valuation somewhere in June 2017 when we were seeing these interest rates coming off very, very sharply. I think after June 2017, markets also began to realize that the real estate market is slow, plus this Prime Minister's affordable housing scheme. See, this affordable housing scheme is a great scheme. It has already seen 3 iterations and 3 rounds of improvement, but there is still not enough demand which has come. So, when you don't have enough demand, and at the same time there are more than 84 players which are operating in the housing finance space. So in the last 3 years, 34 guys have got approvals from NHB to start a housing finance business. So I think it's more of a space which got overcrowded because of the long-term story, but that demand has actually not come up. Maybe it will come up in a year or 2. But I think the demand is still not there. So valuations which have corrected from say the highs of June 2017 to this March 2018, I think it was something which was waiting to happen. Like, we also had downgraded this sector in a large way in June 2017, and that has played out. And you look at the affordable housing space also, a lot of new players entered with a fanfare, but I think everyone has not done well. Look at Repco Home Finance, or you look at Aspire Finance, which is a subsidiary of Motilal Oswal, which is again listed on the exchange, then Sundaram, Shriram, everybody had a very bad experience in affordable housing space. So I think this space has become very crowded, demand is yet to pick up, so we don't see any reason why this space should re-rate in a big way in the next 6 to 12 months. So I think we will like to stick with the well-established players who have a very long track record. So in the large ticket housing space, we think HDFC, it's a sort of, very standard boring bet, but we think that, the markets are so tough that it's only guys like these who can withstand this market and still show some 15-18% growth. So HDFC is one pocket where, somebody can look at. Second pocket where we think some money could be made is Diwan Housing. It has a 30-year history in the affordable housing space, and I think which is why this company is well geared to ride this affordable housing boom whenever it comes. Like, we are of the opinion it will come from next year, not this year. So Diwan Housing looks good. I think the valuations are good. A lot of company specific improvements are happening there. So I think beyond these two names, we are not too positive on the whole space. We think a lot of other retail NBFCs could do far better, like the consumer finance, the two-wheeler, the microfinance. I think that as a pocket should do reasonably well compared to housing finance.
Right. Digant, you just mentioned that there could be a little bit of a recovery in the next 12 odd months. My question really is that what is it that you will be watching out for in terms of recovery in the next 12 months? Because from what we see and what we understand from analysts who track the realty sector, there is still no substantial pickup in demand for commercial or for that residential space, and even in affordable housing we really aren't seeing too much traction. So what is that you're going to be keeping an eye on, and why is it that you suggest that we could see a little bit of recovery in 1 year and not necessarily in another couple of years?
Yeah, see, so the thing is that we always keep on hearing that India has a very large unsold inventory. Like, Mumbai has more than 200,000 apartments which are unsold. So this Mumbai, Bangalore, Chennai, Delhi all together have more than 400,000 apartments which are unsold. But you have to understand that, see, those are apartments which are lying in those segments where there is no demand. The biggest demand is there in the segment which is from 20 lakhs to 45 lakhs. And before this affordable housing policy ever came into being, no builder was really keen to look at this particular segment. So now we have seen that government is trying to give infrastructure status to this sector. Government is trying to tell the developer that, hey, if you develop an affordable housing project, I'll make your entire income on that project tax free. So I think apart from fine tuning the schemes, the government is going full hog to even tell the developers that, hey, come and develop affordable homes. Even if you look at the developers, they are also realizing that those old model of hoarding inventory is gone, it's dead. Now if we have to survive, we need to make houses which are actually what the customer wants. So that 20 to 40 lakh, I think a lot of builders are fine tuning and gearing up for them. So if you look at a Suntech Realty, like they used to do premium projects in Bombay, like they're talking of developing affordable homes now. Purvankara, they have a subsidiary called Provident which does a lot of affordable housing. So I will look at the number of new project launches over next 6 to 12 months by a lot of these established players, because that is where the demand is. So now you have to marry where the consumer demand is and where the builder expectations are, and I think that marriage will happen over next 6 to 12 months, because now RERA is also almost 8 or 9 months old. So a lot of people have started understanding RERA. 21 states have adopted RERA. They have a MahaRERA, they have a website where the projects can be registered. So I think the consumer trust will come back someday, and you will see these project launches happening. So the day this thing happens, we can say that yes, the housing finance sector may also find its bottom, and you could actually see some demand revival which will happen.
Okay, fair enough. Digant, you've highlighted or spoken about your perspective as far as affordable housing loans are concerned. You've also raised some concerns with respect to the non-housing loans. Just wanted to understand what your thoughts are, and how do you expect asset quality in the non-housing finance segments like LAP, developer loans and corporate loans to pan out or to shape up, and also a word on how you expect Q4 earnings to be.
Yeah, so I think, see, as far as the non-housing portfolio is concerned, see, LAP has already seen a lot of stress, and we think that will continue. See, because LAP is essentially financing the small businessmen or the slightly larger businessmen. So they have been impacted by demon, GST, and some of those impacts are still there. And when your property prices are not going up, it's always very difficult to repossess, liquidate. So I think the stress in this segment should get a little higher. And as far as the developer loans are concerned, see, all these people like this PNB housing or India Bulls housing, they have a very good collateral cover with them. But what do you do when they are not able to sell the flats? So I think we expect that there will be some bit of cash flow delays or some bit of asset quality spike which may happen in this portfolio, not necessarily in the Q4 results, but over a period of next 2 to 3 quarters. So I think we would be a little cautious as far as these players are concerned. The ones like PNB Housing or someone like India Bulls, or there are some other companies, Piramal, who's been very aggressive in this particular segment, or someone like an Edelweiss or an IIFL have also been reasonably aggressive here. So I think we'll be careful on these names which are very heavy on this, because we are expecting next 2-3 quarters that some bit of asset quality problem might come in if the sales do not pick up. So which is why I think this is the whole segment where we just want to be with HDFC, because they were the ones to slow down their LAP and slow down their corporate loan portfolio 2 years back, which was very early in the cycle. So we think HDFC could probably wither this particular period of softness in a much stronger way versus others.
Right, fair enough, Digant. I guess HDFC is something that not only analysts in India but analysts across the globe will be pegging on. But Digant, thanks for joining us and giving us your outlook on the housing finance space. Of course, that's something that we're going to continue to track. But we'll move on and move from housing finance to the retail sector. And we put the spotlight on VMart Retail because this is where we've seen the company constantly open new fashion stores, and it's opened its latest fashion store in Uttar Pradesh, taking the total number of fashion stores in that particular state to around 56 and about 17 composite stores. Let's get an idea of what the plans are for VMart Retail, which has been in the news, and we've often spoken to the management. And once again, we have the Chief Financial Officer of the company, Anand Agarwal, joining us to discuss the prospects of the company. Anand, good morning and thanks for joining us. Let me just start off with the real question on your biggest markets, Uttar Pradesh and Bihar. And if I'm not mistaken, in the conference call, you guys had suggested that Bihar has a much more disposable income as in comparison to Uttar Pradesh right now. I just want to know, how is those two geographies panning out for you, and how would you compare one against another right now?
Thank you and good morning. I think both the geographies, Bihar and Uttar Pradesh, are equally promising for us. And while we are not really concentrated or planning to concentrate on only these two states, but definitely, as in the past, we've got some very good returns and good performance and good consumption stories coming in from both these states. So it will be slightly improper to actually compare state versus others in terms of our performance, because basically it's our internal challenges which allow us to grow in a particular state or in a particular geography. Having said that, I think we are equally bullish on not just these two states but the entire Indo-Gangetic plain, where we have been fairly strong, and we will continue to increase our presence in equal stead going forward.
Mr. Agarwal, after Tier 2, Tier 3 cities, you're now making a foray into the Tier 4 cities. So while obviously the cost of property lease or acquisition would be lower, what about returns?
We have seen so far encouraging returns from, while the cost of rentals is marginally lower, but apart from that, almost every other cost is very similar. So it's not only the cost of the rentals which is inducing our decision to get into Tier 4, it's more like a pilot. And while it's been less than a year while we ventured into Tier 4, so far what we've seen gives us promise, and it just opens up another opportunity and more availability of more headroom for us. So we continue with our expansion in Tier 2 along with Tier 3 and Tier 4. So we're not going to concentrate only on tier 4. We will continue to grow in all the three tiers of the geography.
And Anand, what targets can you share with us when it comes to financial year 19 in terms of stores that you guys want to open, any number that you have, any cities that you'd like to expand, and also if you can share with us targets, if you could also tell us about the financials, or rather the investments that this expansion will entail.
So we continue to look at adding between 15 to 17% to our retail operating area year on year, which roughly translated into around 31 stores in the last fiscal and should translate to around 35 odd stores in the next year. As far as the areas of expansion are concerned, I think we will continue to grow in the areas where we are currently present, which is the Indo-Gangetic Plain. We follow a cluster-based expansion strategy, which means that we will continue to open stores in the immediate vicinity of existing towns. And if that means that we need to cross a state boundary, we will do that. But we will not hop over to any state and open up operations in uncharted territories. So we will like to open stores in nearby areas where our brand presence and salience is slightly better, and so that's the expansion plan. In terms of the financial numbers, while we do not really give out a guidance, but the past trend suggests that we should continue to keep growing at around 20% plus year on year, and that is the immediate target that we have on site.
Since you're aiming to do about 35 store rollouts every year, what would, what kind of same store sales growth would that translate into? Is a number closer to 8 to 9% more realistic?
Yeah, absolutely. I think internally we take a target of around 8 to 10%, depending on market conditions and our own abilities. But 8 to 10% is what we target. And if I look at the last 5-year CAGR, it has been around 8%. So between 8 to 10% is something that I would, be bullish about.
You all have also brought down your inventory days from about 113 way back in FY12 to about 85 currently, if my numbers are correct. Can we expect them to go down further, even from these 85-day levels?
Yeah, absolutely. So we are continuously investing in a lot of technology, both at the warehouse level and also in the supply chain mechanism, and also at the stores, to bring about improvements in the the inventory cycles. We should expect some results in the coming financial year. May not happen in this financial year, but definitely in FY19 we should see some good results coming in from that front.
Right, Anand, in the previous conference call, what we also got from the management is that a lot needs to be done in terms of presentation of products. Can you give us any updates about how this is being carried on, and how you guys are now putting on the goods?
Yeah, absolutely right. So we've been working apart from the technology part on the supply chain side, but on the retail front and on the the front-facing customer front, we are doing a lot of effort to improve the visual merchandising. We are getting in a lot of new ways to do up a store. So in fact, if you look at the new stores that we've opened, we have made significant improvements in the lighting system, in the way the merchandise is dressed up, in the way it is presented, and even in the the merchandise itself. And that has also resulted in some good numbers coming in through the last 3 quarters, for which the results are already out. And we hope that whatever is investments that we have done on the retail front, in terms of visual merchandising, in terms of the the look and feel of the store, in terms of even refurbishing the existing stores to bring them in line with new stores, will help us reap better revenues.
Anand, the company, of course, has insignificant levels of debt, and you're also sitting on a comfortable cash that you all have on your balance sheet, which makes V-Mart or gives it an edge to the company for any sort of inorganic opportunities. Is there anything on the anvil or under consideration? Is that a strategy?
No, I think not. So as of now, we remain comfortable in the space we are. We're not looking at inorganic growth. We do keep getting inquiries and opportunities which for evaluation. But as of now, we have no firm plans to get into any kind of acquisition. So we firmly believe that while the growth may be slow, but the track record of the company is it displays the kind of the growth that we have been able to have on the basis of our own organic efforts is good enough for us. So inorganic, while definitely may add to top line, but definitely has its own set of challenges. So as of now, we remain firmly committed on organic growth plans.
All right, Mr. Agarwal, thank you very much for joining us here on Bloomberg. It was a pleasure talking to you. That was the management of V-Mart, reiterating their focus on organic growth. They're looking to launch about 35 stores every year and internal same-store sales growth target of about 10%. The stock trading about 1% higher or so. But with that, we move on to our special segment, Bloomberg Edge, where Jayesh Khilani tells us about a pattern that the Bloomberg terminal has thrown up. Jayesh, what's on your radar today?
So Shraddha, what I'm watching out for is the Nifty PSU Bank Index. That is because it had been trading about 22% lower from its 200-day moving average, but we have seen a bounce back from there. And what can we expect? Let's have a look at the chart that we have. So what the blue line shows you is the percent change from its 200-day moving average, whether it is above or below. And you have an average line which stands at about 5% higher. So what you can see is that the Nifty PSU Bank was actually trading more than 20% lower from its 200-day moving average, and that was last seen sometime in before June 2016, when it was actually trading about 25% lower from its 200-day moving average. What we see is that there has been a bounce back in this ratio, which means that the PSU Bank Index has started going up. And if the average line is to meet with in the last couple of years, you can see that this blue line has largely been above the zero baseline, and the average line stands at about plus 5% from its 200-day moving average. So right now we are at about 11-12% below the 200-day moving average. In case it goes to the average line, we can see outperformance from the Nifty PSU Bank Index.
Okay, Jayesh, thanks for bringing us that particular trend. Of course, we bring you a Bloomberg Edge chart every day, so you should be watching out for this particular segment. But with that, we've run out of time on the show, so it's a wrap on this edition of Trend Spotting. And we leave you with the Nifty closing at around, or rather hovering around 10,400. But don't go anywhere. Hot Money's up next with Darshan Mehta. Stay tuned in Bloomberg Edge.